Can the same argument be extended, because you not shied away from PSUs, I'm asking this question, can the same argument be extended to some of these defense / shipbuilding / other stocks? Because I mean, the results are fabulous, but the rallies have been very, very high.
So in defense space also, I mean, our call is fairly different from what the rest are talking about. Our call is that, so the rest are saying that it is indigenization and obviously the spends by defense of Indian government. But our call is that it's a matter of time before India becomes an outsourcing base for the world in terms of defense products. And it's already happening. In certain of the stocks, it's already happening. I won't name them, but it's already happening there. Apart from the move to indigenize the defense imports, right? So that if you see globally, the world is spending more on defense, given what's happened between Russia, Ukraine, Taiwan, China, and obviously Israel and Iran and all this whole Middle East area. So it's obvious that this is a very exciting sector to be in, where the growth rates are higher. The FMCG part, the problem is that the growth rates can't be exciting because there's only that much that you can grow, because you're talking about a product which is saturated in terms of the Indian markets, right? So that's why I said the mid-teens kind of growth is the best that you can assume in FMCG. But at least in the case of defense, you know that the growth rates are going to be far higher and the future also looks far brighter. So that's why you can stick along with valuation, but there again, the valuations are not that much away. They're not like 3-4 times PEG, right? It's like max 2 times PEG as such, so that way. So you can very well assume that things will pick up at some point in time. So.
Got it. Viewers, for people who don't quite understand this, what he's saying is price earnings to growth ratio, which is that you put the peg the price earnings multiple to the growth, and if those numbers are not out of whack, which is 3-4 times, then the stock may still be reasonable, even if on an isolated PE basis the stock may look expensive, because you pay a premium for a high growth company. So Dinshaw Irani is talking about how some of the defense names actually have a good growth, and that's why they are not as egregious as maybe some of the FMCG names be. I hope I was explaining that clearly. Okay, great. So that's on defense. The two other pockets that I wanted to just briefly talk to you about, one of them was around this whole consumer tech, fintech, etc. You have presence there in the past, you've held them, stocks, etc. We saw a flurry of names, then there's a bit of a lull in the last few. Maybe we are preparing for some more to come in as well. But we now have an active sector in place there. Companies are now talking about profitability, aside of only talking about customer addition, right? Are you looking at this from a slightly longer term perspective, and do you like some of these stocks here?
We love some of these names. I mean, you've seen that in our portfolio. Basically, we call them platform companies.
Exactly.
The fact is that you should look at the potential of these guys, right? I mean, to name one particular company that we've been associated with for a fairly long time is Zomato, right? The fact is that the kind of optionality that particular platform has is humongous. He's not even got into data mining right now. Excuse me. So that is another optionality that he has. But the fact is, look at the growth story out here. Globally, there are only 2 players in all the markets who dominate the market. I mean, look at US, there's DoorDash and probably Uber Eats. Yeah, you look at say China, there's Meituan, and there's one more who's a marginal player. I can't even pronounce that name. In Singapore also there's Grab and there's one more, right? So in India there's no different. And these 2 guys are going to dominate a market which ultimately will be around 300 to 400 odd million consumers at some point in time, right? Given the kind of demographic changes that India is going through. So it's obvious that the growth rates are going to be phenomenal. And you've seen that in the case of Zomato, for him to turn to profits was not a big deal at all. And that's what he kept telling everybody, that look, I'm in losses because I've chosen to be in, I want to grow right now, and I can turn into profits whenever I. So that's what we like about these platform companies. Basically, there are other platform companies. What you look for in a platform company is 4 things. One is, do they provide convenience? Is that mass convenience? Is it uncashable? If these 3 answers are yes. And the 4th one, which is it easily replicable? If that answer is no, you want to be in that platform company, given the base that India provides. So.
Okay. So you do believe that platform plays are here to stay and grow and thrive?
Yes, selectively.
Selectively, of course.
It shouldn't be easily replicable. Convenience is always there. You should be able to encash that convenience, and shouldn't be easily replicable.
Got it.
Which is the case with Zomato. But if you see some other platform like in fashion, there were a few, or so I don't want to name them, but it's easily applicable, that model. So that's why we don't like those kind of